Hello Sector Watchers, welcome to the 23rd episode of Sector Spotlight on Tuesday, the 24th of March 2020. This is your weekly update on sector rotation and anything remotely connected to relative strength and or rotational analysis. My name is Julius de Kempenaer and I'm your host for today's show. I'm based in Amsterdam, the Netherlands. As you can see, it's a pre-recorded version of the show. It's now Monday the 23rd, about 24 hours before this actually goes on air. Obvious reasons why we do that. It's not going to stop us from trying to do market analysis and providing you with commentary as good as we can in current circumstances. What I would like to do in this show is obviously go over the rotations that we've seen in the last week or two from an asset class and a sector rotation perspective. I'm going to use some daily RRGs for that because I feel that they are better in highlighting and visualizing the price action of the last few weeks. I will then also go into the use of RRGs and sector rotation using equal weight sectors. I've actually written an article in the RRG blog on the site about that last week, and I will highlight a few items from that blog in this Sector Spotlight show. I think it gives you some very interesting takeaways that we should look at. Furthermore, we will go back actually to a question that I dealt with in Sector Spotlight last week. It was a question from Eduardo with regard to plotting and visualizing ratios or pair trades. I got some further insights to that that I want to share with you. And I will also go over some of the pair trades that we highlighted in the past and provide you with a new pair trade idea for this week and maybe some weeks to come. Let's go and have a look at some charts. And here we are. On the left hand side you see the perf chart for some asset classes that we usually track here, and on the right hand side you will see the accompanying relative rotation graph. Another weak week for a lot of asset classes. The only one with a positive return was the US dollar. Treasury bonds only down 86 basis points, and then we have the benchmark that we use, the VBINX, closely followed by, this is commodities, and then here is ITOT, the core S&P total stock market, down 4.6% for the week. Devastating week for corporate bonds, real estate, and high yield. And although you wouldn't say that on the RRG, which is here on a weekly basis, and it's still showing corporate bonds and government bonds really doing very well, high yields starting to close in there. Although the risk off message is pretty clear. You see stocks here, real estate, commodities down there. But if we shift this to a daily version of that RRG, you can definitely see the impact of that minus 12% for corporate bonds during that week, because it actually rapidly turned around in the last 5 to 10 days together with high yields. So so much for risk off. These are actually becoming more and more risk asset classes. And you see the dollar being very strong here, and you see government bonds still going to the right, outperforming the benchmark by a mile, not surprisingly. But please be aware that with yields now reaching such low levels, that the lower yields get, the higher the prices of these bonds get, obviously, the riskier this becomes as an asset class. So please be aware of that bonds, the lower the yields go, the higher the bond prices go, the less of a safe haven at least the longer dated bonds are. If we go to the sector version of the perf chart, we quickly load up the sector ETFs. And we see, this is relative, we do it in price terms, everything was negative. Technology was only down 1.6, but real estate down 8%, more than 8%, industrials almost 8%, etc. If we do that relative to the S&P 500, we see technology, discretionary materials, communication services sort of outperforming, which means that it probably was a good week because these are high beta sectors doing really well. So we see the low beta stuff, utilities, industrials, real estate. Energy, by the way, is very high beta, but it's going really, really down. Doing not so well. If we bring that to the RRG, then we got an interesting picture here with the energy still powering down, like, you know, it's completely detached from all the other sectors. We see technology still doing relatively okay, going to the right. Staples doing okay, utilities. So these are all the risk off sectors, defensive sectors showing a risk off message, together with healthcare and communication services. If we do this on a daily scale, you see a little bit different picture. Gives you a little bit more granularity about the last few weeks, last 5 to 10 days. And then you see that the risk of asset sectors here, tech, discretionary materials, they were actually picking up a little bit. You see tech there. Where is the materials turning up right there? It's only minor in this bigger picture. You see that one good week doesn't immediately improve or really improve a tail on the RRG. So you see the improvement of materials is only like a couple of days. If we do it for technology actually a pretty good sector, has been all the time, is also still pretty good on the weekly version of the chart. If we go to communication services, that's still pretty close to the benchmark. It's traveling in the right direction. Interesting sector to watch. Please stay away from real estate because it's deteriorating really, really rapidly. It should be, or it used to be, a defensive sector, risk-off sector. Doesn't look like that anymore, at least not from what I see on the charts. Industrials, not a very long tail, but very stable, pushing further into the lagging quadrant. And financials turning up here inside the lagging quadrant. Not a pretty good week, but the last couple of weeks this was actually starting to turn up, and we're going to have another look at the financial sector later on in the show. But so far I think that the longer term weekly chart still shows you a risk off message for the market as a whole, with all these defensive sectors inside leading and the more offensive sectors inside lagging. And if we zoom in on the daily, we see a little hiccup for the sorry about that, a little hiccup for the more offensive stuff, but it's really questionable how long they will be able to keep that up, because the market is flying high and flying low, throwing us all kinds of curveballs. As you know, the show is pre-recorded. It's now Monday. Here in Europe, markets opened about 4% lower than they closed on Friday. During the day, lots of messages came out about relief packages, etc. We went almost back to unchanged, and then when the US opened lower, we started to go lower again. And it's like it goes with percentage points at the same time. So please stay close to home, no big bets, and we'll start to monitor, or continue to monitor, what's going on in terms of sector rotation. Most Thursdays I write an article in the Don't Ignore This Chart blog. Last Thursday, March 19, I wrote an article that was titled Subtle Differences Between Equal Weight and Regular Sector RRGs. And this is the article here. It's a relatively short article, but I thought that the subject was well worth taking a closer look in the show here. Here I have on the left hand side an RRG that's loaded up with the equal weight sector ETFs, and on the right hand side I have the regular ETFs, State Street Spiders, as we usually use them. As you can see, the general picture is similar, but there are a few subtle differences. The first one that I want to point out is the position of technology. In the equal weight RRG, technology is not the strongest in terms of RS ratio. That's actually healthcare. On the regular RRG, technology is still far to the right. To me, this means that the heavyweight stocks in that sector are driving this performance. So it's actually the heavyweight stocks inside XLK, inside the technology sector, that are driving this strong performance for XLK. So that's one thing that I wanted to point out. The other one, closely related, is healthcare. You can see that they're close together here on the regular RRG. So if we highlight healthcare, you see that it's doing nice. It's just rotated from weakening into leading. And on the left side, the healthcare ETF, RYH, is inside leading and powering to the right, which is a strong thing. But it's all about the relative position. If you look at healthcare here, it's actually the strongest in terms of RS ratio, in terms of relative strength. If you look at it on the regular one, it's still good, but it's not the strongest. So to me, this means that the big pharma is lagging behind the rest because the equal weight is further ahead than the regular one. So this is a way that you can actually play with equal weight versus cap weighted ETFs and find interesting relationships that may give you a clue or some guidance on which part of the sector, large caps, smaller caps. I know it's the S&P 500, so they're all large caps, but still there are some differences. Maybe you should say mega caps versus normal caps. I thought it was an interesting relationship to keep an eye on and to monitor going forward. Obviously, energy is really, really bad on both sides. One other thing, which I also highlighted in the blog article, is the relationship between staples and discretionary. Usually there is a pretty clear split between staples and discretionary, especially in risk on, risk off type markets. And the relationship on the regular RRG between staples and discretionary, where is discretionary? Here, is not very pronounced at the moment. Staples is very pronounced, that is a very clear tail, but the discretionary sector is like, it's hovering there, it's just sitting there and not doing a lot. Let's just look at that, the length of that tail. That's not a very long tail. You see a nice rotation and then it completely drops and comes almost to a standstill. Unless staples, that is actually turned around and starting to shoot off into the leading quadrant, fulfilling its defensive role. Now, if we look at the same two sectors on the equal weight version, then we have staples showing a pretty similar picture, left and right, they're almost the same. And then if we go to the discretionary one, then that's where the difference is coming in. You see that the discretionary equal weight ETF is going almost opposite to the staples ETF. So that's a pretty clear split. Clearly that has to do with big names in that XLY, consumer discretionary ETF, But these are the things that can put you on the right track when you at least keep an eye on what's going on in the equal weight universe. By the way, please note that the benchmark that we use for the regulars is SPY, and the benchmark that we use for the equal weight ETFs is RSP, which is actually the S&P 500, but then equal weight. Just wanted to give you this because I think it's a cool way, it's a different way of visualizing sector rotation, and it's definitely worth keeping an eye on because it can show you some subtle differences in the relationships. We're going to have a quick break now, and after that I'll be back with an update from the Mailbag and some pair trades. In last week's Sector Spotlight, I answered a question from Eduardo from the Mailbag, and it had to do with plotting and visualizing ratios on an RRG. I do a lot of ratios, and RRG is all about ratios, so initially I answered Eduardo like, okay, you can do that. You basically just plot the two legs of your ratio on that RRG, and it will show you how that relationship behaves and whether you should prefer one over the other, which basically means if you want to be long or short that pair. So far so good. I still think it's a good answer. I still think that RRG does the job pretty well in that respect, but very often, or at least I very often have things that then, once you've talked about it, thought about it, you continue to think about it. And in my case, I also got a few mails, which I encourage you to do always, to keep sending me emails because they help tremendously in coming up with valuable content for this show and for the blogs that I write. And in this case, I later on only realized that I had a similar question from Gary a few weeks ago, and we talked about that in Sector Spotlights a few weeks ago. It was about using RRG to indicate switching between pairs such as SSO, SDS, QLD, QID, TLT, TBT, which are basically the leveraged long and leveraged short ETFs for the S&P and the NASDAQ and treasuries, which are also ratios that you can plot perfectly fine on an RRG. I just always have been and always will be plotting the individual legs on the RRG and then look at how that relationship develops. That's why I actually answered Eduardo about why would you plot the ratio instead of the two legs. That basically was my shortcut to that answer. Then I got also an email from Charles last week, who sort of caused a light bulb moment, because he actually said that if you want to look at the ratios and plot the ratios on the RRG, then the benchmark should also be a ratio. And then he started comparing it to currency pairs. And for me, that was the light bulb moment, because you may know that I do a lot of stuff with currencies, and I do visualize currency rotation on RRGs. I actually wrote an article about it last Friday in the RRG blog. You can do crazy things with currencies. But the remark that Charles made on having a ratio as the benchmark pretty much sort of solved my problem with the answer to Eduardo, because it's actually, you don't need a ratio as a benchmark. you need the same benchmark as we use for currency rotations, which is $1, because in the currency pairs, we bring everything back to a base currency. For US denominated investors, that's usually the US dollar. So we set up the pairs like JPY USD, GBP USD, EUR USD, and we compare it to $1 because the benchmark is the already in the pairs. It's the denominator of the pairs. That got me thinking again. I was circling back to that question of Eduardo and the remark of Gary about the ratios that they were watching, on how to compare that. And then it sort of clicked with me that they actually wanted to know, when should I be in this pair or when should I be out of it, or reversing it probably. And you can actually plot that on an RRG. And I've also, during the same thought process, figured out how to do it, because the standard RRG implementation doesn't accept a ratio as an input. So let's see, Eduardo was looking at SPHB versus SPLV, high beta versus low vol stocks. Very interesting ratio, by the way. So you can plot those individual lags on an RRG, but you cannot put the ratio SPHB divided by SPLV as a trail on the RRG as it is right now, and then compare it to something else. So what I want to do is show you how I solved that problem using UDIs, user-defined indexes, on StockCharts.com, and offer you a way to actually plot multiple relationships, multiple pairs on an RRG canvas. And I thought that was pretty cool, so I'm going to share that with you. And I need to go back to my desk to actually show you my screen and share it and tell you exactly how I did that. So stay tuned, I'll be back in a second. Okay, so when you work with ratios or pairs, and you would like to show them on an RRG, then that doesn't work. And let me show you. This is a blank RRG canvas. If I would put in the ratio of SPHB, now watch this, colon SPLV, which is basically the ratio between the high beta and the low vol ETFs, and I hit enter, it would not accept it. It doesn't accept that. There is a trick to overcome that. And what you actually need is user indexes. You gotta be an extra or a pro member to use user-defined indexes, but they are really, really powerful things. I don't have enough time to actually show you how you do this and upload it, but I will either do a short video and or write a little article so you can always go back and see how it's done. But what I've done is I've created user-defined indexes, UDIs, for some of these pairs. For example, the HBLV, SPHB, SPLV pair is this UDI for me. Now, if I would bring that one, that ticker symbol on the RRG, which is at SPHB, SPLV, and now I update it, ta-da, here is my ratio. So now I'm actually looking at this pair versus SPY. Now, as you can see, I have created a few of these pairs that we've just been discussing, and I can now actually run these pairs, and these are they're characterized by the @ sign, in front of the ticker symbol, so at QLD, QID, etc., etc. And here I have compared them to $1, and you see you got a perfect RRG showing you that the long bonds versus short bonds is the right one to have, and that you should either be the reverse on this pair or short this pair. I don't know how to best to say it, but this is the S&P, this is the high beta low value, this is the Nasdaq pair, and you can see that they send pretty clear signals. Now watch this, look at the percentage changes. This is 5 weeks. You can also do this on a daily, but look at the percentage changes that these pairs go through. This is leverage trading. So you got high rewards, but you always got high risk. So please be aware of that. If you know what you're doing, this is super powerful stuff, and it finally answers Eduardo's question: how can I plot all my pairs on the RRG grid? The answer is do it with user-defined indexes. Here you go. Before the break, we had a look at the equal weight RRG, or the RRG that shows equal weight sectors versus the RRG that shows the regular cap weighted sectors. And while I was writing that article and while I was doing my research and browsing through the two RRGs and comparing them with each other, I thought it would be cool to see if I could find a pair trade idea that was including an equal weight ETF versus a cap weighted ETF. And the one that caught my eye was the financials one. If you look at the equal weight ETF, which is RYF, it's inside lagging, curling upward. By the way, this is a daily RRG. And the counterpart on the other side is XLF, the cap weighted ETF. Similar position, also curling upward. So it looks as if from both perspectives, equal weight and cap weighted, the financial sector, at least in the near term, looks to be improving versus its benchmark. Now, as you know, always the final test, the final check that you want to do if you want to go into a pair trade idea is to put these two together in one chart. And that is the regular sharp chart, and you can simply enter XLF:RYF. And I'm not going to take you through the whole process, but especially when I lengthened my horizon, all of a sudden I noticed that this ratio is coming out of a super long base. We had this massive decline, which means equal weight was outperforming cap weighted. Then since 2012, it's been in a trading range, and very, very recently, the ratio is breaking out, which means that this suggests that the cap weighted ETF is going to outperform the equal weight ETF. Translate that, it means that this suggests that the larger financial stocks, the larger stocks, large cap stocks inside XLF are actually going to dominate and drive the performance of the financial sector going forward. We're going to put this trade in as a pair trade idea, and let's see how this goes in the next couple of weeks. That's it. This was the 23rd episode of Sector Spotlight. Sector Spotlight airs every Tuesday, 10:30 to 11 a.m. Eastern. Meanwhile, if you want to read more about sector rotation, please go to the RRG blog on StockCharts.com, or even better, subscribe using the link below each article. That's it for now. Stay safe, and I hope to see you again next week.